the United States and China, most importantly, are approaching a war, the greater risk of war, and also Russia is in that there have been, supply lines, supply chains have been broken and supply lines and so on. And that has worsened this set of circumstances for reasons having to do with geopolitical and so on. So we are in that spot. Now, let me be more specific. What happened in this period is that a lot of government debt was sold. And it was sold to a lot of buyers. So when you look at Silicon Valley Bank situation, and it's important to understand that that's just one example of an enormous number of cases in which short-term borrowing was used to finance the purchase of a lot of government bonds and beyond bonds beyond that, mortgage payments and also corporate bonds and so on, because money was given away free. I mean, think about it this way. The interest rate the government interest rate was 0.7%. Low grade credits were about 3.5% interest rate, but they also had interest only loans. So it meant you really didn't have to pay hardly anything to get money. So we have all of that debt and now the government bonds have gone down, and it's funded by short-term debt, which the cost of money has gone up. Now, that's not just banks. That's not just the United States. That's a world phenomenon. It existed in Europe because the central banks there in Europe provided money like that. Imagine they created negative interest rates for money. So how does somebody make money holding a bond that has a negative interest rate? The way you do it is you have a more negative short-term interest rate that you borrow to fund it. And so that's what went on, and that's what we have. So if you look at, let's say, if you marked to market the bonds that at existing rates, you have a lot of terribly financially hurt, negative net worth entities around the world. The world is leverage long. So we have that dynamic going on at the same time as we have the other things that I was referring to. So that's the financial dynamic. So the canary in the coal mine is meant to reflect two things. First, that it's not just the Silicon Valley Bank. It is a pervasive thing about holding a lot of debt that's gone down in value and being leveraged long. So it's a pervasive thing. And also meant to convey that there's a sequence of events that are like dominoes falling. So, for example, those who are hurt financially and have a lot of that debt don't want to buy more of that debt. Yet the government is going to have to sell the debt. In other words, when they run a deficit, that means they have to sell bonds. And and all of those who have bought bonds, including foreigners, who are increasingly worried about even the value of the debt, but also sanctions. Sanctions means that you freeze the debt. So certain holders of the debt say, I've got a lot of U.S. dollar denominated debt, and I already have maybe too much. And then do I want to buy more? And so you have an imbalance there in terms of selling and buying, which is a risky situation. In addition, there's this sequence of events that takes place, such as those who were making loans, banks who now are suffering from this condition, don't want to make as much loans And so if you look at, let's say, like regional banks, those regional banks make a lot of loans for residential real estate, commercial real estate, although there's a problem with residential too. But so if you look at real estate, commercial real estate, it's vulnerable, but they haven't gotten the consequences that are yet to come in the form of running out of adequate cash flow and not having the money and then having to sell assets and so on.